Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/Markets Plus for more episodes.
I'm Penn Egbert, head of U.S. equity research at BMO Capital Markets. Uncertainty about the global trade environment has risen following a U.S. Supreme Court ruling that found that tariffs set up by the Trump administration under an Emergency Powers Act are unlawful. Responding to the court decision, President Trump announced a new global tariff of 15% under a different legal precedent. This podcast will explore the economic and market implications of these events. To help make sense of it all, I'm joined by Ernie Tedeschi, head of economic insights and research at Stripe. He's a non-resident senior fellow at the Budget Lab at Yale University and a former chief economist at the White House Council of Economic Advisors. We also have François Trahan, our chief investment strategist for BMO Capital Markets, and Scott Anderson, who's our chief U.S. economist, also here at BMO Capital Markets. So, gents, thanks all for joining. Appreciate it on fairly short notice. Ernie, let's begin with you. In terms of the global trade environment, where we were prior to the Supreme Court ruling, and where do most countries stand?
Sure. So if you had asked me a week ago where we were, the average effective tariff rate in the United States at that point, before the Supreme Court decision, was 16%. It had risen from 2.4% at the end of 2024. So to put that 16% in perspective, that's the highest for the United States since the days of World War II. Canada's rate, by the way, was 8.1% as of a week ago. It's lower than that overall 16% rate, mainly due to the USMCA exemptions, bringing down the effective rate for Canada. Mexico was at 13%. China was at 24%, so above the overall American average, and the rest of the world averaged out at 14%. All of the 2025 tariffs that the United States had imposed were, by the end of 2025, raising about $25 to $30 billion a month in revenue. So you can think of it as an annualized rate of between $300 to $350 billion a year. About half of this revenue was due to tariffs imposed under IEEPA authority, so the authority that was before the Supreme Court in that subsequent ruling. The other half of the 2025 increase in tariffs was due to other more legally grounded authorities, 232, 301. These are authorities that apply mainly to commodities, not countries. So, for example, the steel and aluminum tariffs are tariffs imposed under Section 232. The U.S. trade deficit over 2025 was $900 billion. That looks on paper to be almost exactly the same as it was in 2024. But there was a large migration of non-monetary gold that happened throughout 2025 that boosted American exports. So when you take that out, the American trade deficit over 2025 actually worsened a little bit by about $40 billion over the course of the year. Incidentally, though, our trade deficit shrank a bit with Canada specifically. We went from $62 billion in 2024 to $47 billion over 2025. Last thing I'll mention is that we projected at the Budget Lab that the tariffs, as of before a week ago, would have raised price levels over 2 to 3 years by about 1.2 to 1.3 percentage points, assuming that the Fed didn't react to them, which seems consistent with Fed action so far. And we shaved roughly half a point, maybe a little bit less off of 2025 growth as a result of those tariffs.
And then how, on Friday's Supreme Court decision on tariffs, and then President Trump's reaction, how does that alter how countries were operating?
Yeah. So the Supreme Court ruled 6-3 against just the IEEPA tariffs, not the 232 or 301 tariffs. So that immediately brought down the effective tariff rate from the 16% that I mentioned to 9%. And then in very short order, the Trump administration announced a blanket 10% and then 15%. So it is now at 15% tariff that they are imposing under a different authority called Section 122 that I'll talk about in a second. So that brought the effective tariff rate from that sort of 9% in the hours after the Supreme Court decision back up to 13.7%. So still very high, even though with that 15% Section 122 tariff that the administration imposed, still not back up to where it had been a week prior before the Supreme Court decision. Our analysis at the Budget Lab suggests that the effective rate on Canada under this 15% blanket tariff will be slightly lower than it was before the decision, so about 1 to 2 percentage points lower. It will be also about 1 to 2 percentage points lower for Mexico, and it will be significantly lower for China, about 10 percentage points lower, and then slightly higher for the rest of the world. So basically what we've done is we've gone from tariff heterogeneity across the world to something that's a little bit closer to even across the world. And so that has benefited Canada and Mexico, and especially China, to the detriment of the rest of the world, where the average was a little bit lower before. Refunds, which is top of mind for everyone regarding the U.S. tariffs, were not decided on in the Supreme Court decision. They remanded those to lower courts to decide. So we'll have to see in subsequent court actions how the courts decide on how refunds will be handled, or if they'll be handled at all. The last thing I'll mention is that Section 122 comes with its own set of legal questions. Section 122 literally says that the president has the authority to impose tariffs if there is a, quote, balance of payments issue with the United States. So unlike the IEEPA statute that was before the court before, 122 does explicitly authorize tariffs. The two central questions that courts will have to face coming up is, one, do we have a balance of payments issue in the United States, which is different from a trade deficit or a current accounts deficit? Under regimes of floating exchange rates, you generally don't have balance of payments problems anymore. But even if factually we don't have a balance of payments issue, the second question that courts will have to decide is whether courts have any authority to question the president deciding that we have a balance of payments issue. So even if economists and lawyers argue that there is not a balance of payments emergency in the United States, courts may decide that it is not up to them to question a finding by the executive branch that arrives at that conclusion.
Let's bring Scott into the mix here. Let's stick with Section 122. So from an economic standpoint, Scott, why don't you help us drill down to what this actually means on growth and inflation as a result?
Yeah, well, thanks for the question. Well, at the moment, we're not making any major drastic changes to our U.S. growth or inflation outlook for 2026. As Ernie mentioned, the average effective tariff rate hasn't changed a whole lot, even though we're changing, the authorities outlying or striking down the Economic Emergency Act tariffs. Seem to be replacing, the president wants to replace those with higher global tariffs through Section 122. So one thing to keep in mind here is that these new authorities under Section 122 are temporary, and the highest they can go is 15% unless Congress agrees to extend them beyond 150 days. And of course, it's meant to address these large and growing serious balance of payment deficits, which is likely to be challenged by the courts with a trade deficit not especially large, and the U.S. really isn't having any trouble attracting capital inflows at the moment. You certainly can make the case that we're, not in an emergency balance of payments problem at the moment. The other thing I think our customers would be very interested in knowing is basically there are product-based exemptions to this global tariff. So things like critical minerals and metals, energy products, agricultural goods, pharmaceutical products, some electronics, aerospace products. And this is very similar to the reciprocal tariff exemptions that will likely remain in place. Also, for our Canadian customers, the imports covered under the existing trade agreements like the USMCA likely do not face this 15% global surcharge. Also, if your product is also already under tariffs under the National Security Section 232, tariffs or the unfair trade practices Section 301 tariffs, these global tariffs won't apply either. So there are some exceptions here, but overall it's a pretty large blanket tariff that largely replaces, not completely replaces, but largely replaces the hole left behind by the Supreme Court decision. And so I think our customers are going to think this is going to, at least for the time being, elevate the tariff and trade uncertainty risks. We already know that trade and tariff uncertainty is already holding back business investment and hiring decisions. So that isn't especially helpful. But I do think there is an important positive coming out of this. It will likely tie the administration's hands to set astronomically high tariffs with any country the president just decides to do. It's a lot harder to go through the sectoral tariff route. You need to write a report and make a case of why the tariffs need to be at the level you're suggesting. So it's not something that he can just do. So that does reduce probably some of the tail risks on tariffs that they'll actually be a little bit of a positive going forward.
Any influence on the USMCA, the United States, Mexico, and Canada trade agreement?
Yeah, so obviously we're just starting off the negotiations on the new USMCA agreement, but I think it does reduce some of the U.S. leverage around these negotiations. The threat of big across-the-board tariffs is kind of off the table now, thanks to the Supreme Court ruling. So that will give Canada a little bit more leverage, I think, in the negotiations going forward. But certainly the president will continue to press his case on tariffs through Section 232 and Section 301 tariffs that will continue to keep people guessing.
Thank you. Let's turn to François. I just wanted to get the investment strategy point of view. François, how would you describe the market's reaction to the news? I mean, we were down over 800 points on the Dow today. Obviously, there's other factors at play as well. But when we think about commodities such as copper, how do you think global commodities are absorbing the new global tariffs?
That's a good question, Penn. I think everybody's expectations, were shaped by, when it comes to tariffs, were shaped by what took place on Liberation Day. And so I suspect when people saw the original headline, they thought this was going to be a bloodbath. But at the end of the day, I think it's been kind of blah. I always like to look at an index like the Russell 2000, which tends to overreact to announcements like this. It was down 1.5% today. It's still up 5% year to date. And so it's telling you that something is brewing with regards to the economy. It's a very cyclical index. If you look at a chart of copper, honestly, in a daily chart, if you didn't know that this had taken place, you don't really see it. And so, I think Ernie's comments that we went from a 16% effective rate to roughly a 14% effective rate tells you that this is not a huge event for the market. So I think in the eyes of equities, this was kind of 4 quarters for $1. Now, if you were to take this in isolation, and I think you could say all other things equal, that it is slightly stimulative. If your effective rate is lower than what it would otherwise be, and that is less money coming out of consumers and companies' pockets. It also adds up to slightly less inflationary pressures. So I think you would say that the margin, it's a slight positive overall, but it's always difficult to isolate, this impact on a day-to-day basis. It's obviously a fluid situation.
And then just as a follow-up, where do you see the most market risk?
Well, that's a difficult question. Look, I talk about what it means in isolation. The reality is that any uncertainty can weigh on market multiples. I think this is far less risky than it was last spring. And I say this because there's a lot more stimulus in the pipeline that there was back then. There's more rate cuts. There's more time between the first rate cuts and where we are. So the lags are already starting to show up in leading indicators of the economy. We've had fiscal stimulus since. And so I think we're in a different place. And we've had a change in leadership since. We've seen, cyclicality take over the marketplace. And so the stock market historically tends to be very resilient to bad news when it has stimulus as a tailwind. So I don't think this is going to be an overreaction like we had last spring. And even then, the market rebounded in the wake of that. There was some stimulus in the pipeline back then. There's just a lot more today. So I don't think this is as risky at the index level as it was.
And just to add to François' comments, what I'm hearing from our clients and customers is that they don't like the tariffs, they don't love the tariffs, but they're getting used to tariffs in the 10 to 15% range. Those are tariff levels they can deal with. It's the up and down that they don't like. And And I do think there's this change in focus right now on the potential for tariff refunds. And that's making some folks a little bit excited about the possibility of getting that. I don't think anyone's planning their business around getting these tariff refunds, but this is something that could be a little bit of a positive. We're talking about over $100 billion, perhaps almost $200 billion in terms of refunds that could go out over time. Obviously, it could take years for that to happen, but that's something that folks are looking into right now.
That's helpful. Before we finish up, I'd love to just get your final thoughts from each of you on where this leaves the future of global trade. So, François, do you want to leave us with some final words of wisdom?
Sure. I think Scott is completely correct. The market, again, is very resilient to bad news when it has stimulus as a tailwind. So I think it can handle a lot. It just needs to know what the policy is. And so Scott's point that investors are expecting something in this range tells you why there hasn't been a crazy reaction, at least thus far.
And Scott?
Yeah, so I think the U.S. will continue to provoke, on the trade and tariff front, especially, across its major trading partners. And what I see happening in the future of global trade is I do see other countries trying to move around the United States as best they can and try not to provoke further aggression on the trade front. So you're seeing other countries going around and signing new trade agreements with one another that does not put the United States at the center or excludes the U.S. altogether. So I think just in general, trade will go forward. Global trade has actually performed quite well over the past year, despite these ongoing tariffs and tariff threats and trade war. Trade will not be determined just by economics and profits going forward, but countries will also be considering national security concerns, diversification of supply chains, and trading partners as important elements of trade agreements going forward. So I also think, we should look ahead to the midterm elections. Should the Democrats take both houses of Congress, you could see a little bit more restraint put on the administration. Congress, as you know, is the branch of government that has tariff authority, and they could take some of that power back from the administration. So, if that change in power were to happen, you could see at least, maybe some handcuffs put on some of these tariff actions, a little bit more stability returning to trade policy going forward.
Thanks for that, Scott. And Ernie, want to leave us with a few final thoughts as well?
Sure. Look, make no mistake, this was a major decision by the U.S. Supreme Court, but it actually resolved very little about the tariff question at the end of the day, because it leaves us with a lot of uncertainty. I completely agree with Scott earlier that it reduces the leverage of the United States in future negotiations. It gives us no resolution on what the final tariff policy of the United States will be, because the administration has only now begun the process of further 232 and 301 tariffs. There's no resolution to refunds, which is the sort of biggest carrot on the board here in terms of tailwinds for companies. That's potentially up to $140 billion going back to companies this year, depending on how courts rule on refunds. So no resolution on that. And then shifting to this 122 regime opens up political uncertainty, as both Scott and François mentioned, where we have the 122 tariffs last for 150 days, which puts the vote on extending them by Congress to very close to the midterm elections in a political environment that is already very fraught. So it is very unclear where we're going to end up at the end of the year. I don't think much more clear than it was a week ago before the decision.
Great. Well, gentlemen, really appreciate your insights today. François, Scott, and Ernie, thanks so much. And for more perspectives on capital markets, stay tuned to Markets Plus. Thanks all.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.